I started writing code when I was like 9 or 10. Instead of high school, I went to a college where I did a degree in computer science, graduated at 18.
Where you're just putting the Legos together on the Bitcoin security side and on the need for liquidity side, maybe on the DeFi side, and a bunch of others as well.
If I put three boxes together or if I build a skyscraper, the engineering complexity and effort is quite different. So Alice and Bob and Olivia, the Oracle, have kind of created these pre-commitments and they've traded the signature, whatever, and like that kind of unlocks it.
Hello, hello, hello. Welcome everybody to another episode of the PYOR podcast, a podcast where we talk to interesting folks in the crypto space, on the investing side, on the building side, but more importantly on the degen side. And we certainly have certain someone there with us today. In the last episode, we spoke to Yash from Surge, who was building Bitcoin rollups as a service. I feel like this is a good second episode to that to understand more about the programmable space within Bitcoin, probably from a different angle. And there's a lot of news around wrapped Bitcoin, and this seems like the best time to talk to Aki. Yes, my next guest is Aki Balogh, who is the co-founder and CEO of dlcBTC. We will get the full form of that and a wonderful description of that. An issuer of a wrapped version of Bitcoin to bridge the gap between Bitcoin security and a smart contract blockchain's programmability, something like an Ethereum or Solana or any L1. dlcBTC is backed by stalwarts like Sequoia Scout, OKX Ventures, Chainlink, and more. Before dlcBTC, Aki worked with Dekai Group on the business side, and he has a ton of experience on that side as well. So welcome, Aki. Great to have you. Very interested to know more about dlcBTC. First of all, would love to get a background about you, more than I have already just said, so that we can go deeper into what you are doing with dlcBTC.
Yeah, it's a pleasure. I'll try to keep it short because I'm 39, so I'm almost next year 40. So I've been in the working world for some time, I guess. Yeah, I was born in Hungary, grew up in Boston and Michigan. I started writing code when I was like 9 or 10. Instead of high school, I went to a college where I did a degree in computer science, graduated at 18. Then I went into undergrad business school, 2 years of management consulting, private equity, VC in Boston in 2011, where I was the first associate at the fund looking at big data, AI, machine learning. Back in 2011, I wanted to start an AI company just to basically like figure out like what kind of real world problem could AI solve? So I started a marketing company. It was an AI optimization for content marketing. Worked with some scientists. I invented a way to use, or we, I should say, with the scientists, invented a way to use machine learning to optimize content for search, for SEO. I built a company around it, Market Muse. I raised over 10 million, hired like 50 people, made all the classic mistakes of a first-time founder. And then kind of coming off of that, after 8 years, I wanted to do something different. I'd heard of Bitcoin in 2011. I heard of ETH early, but I didn't have the time to really focus in. So I missed the big, run up on the, in terms of the value. But hey, look, next best time is now. I'm not going to be able to wind the clock back to 2011, but even today we can build things that are going to make a big impact. And so I came full time in 2021. I actually found this company, Dekai. I didn't work for them per se, but I advised them. And actually, they have a very cool story too, which they're a software engineering shop. So they don't do a whole lot of marketing. They do more word of mouth. But I actually introduced them. There's like brilliant engineers in Hungary. I introduced them to my friend here in New York, and he ended up hiring them to build the Chivo wallet for El Salvador. And I only mentioned that because President Bukele was just listed on the face of Times or People or whatever. So I just saw a tweet that that he's really transformed El Salvador with this Bitcoin wallet. Well, that was built through our friends at the Kai. But anyway, that was just an advisory thing. Instead, I came to this space and I wanted to build on Bitcoin because I didn't come in as a maxi or anything. It seemed that I was watching the MIT Open Courseware on Bitcoin, and it seemed that Bitcoin, the technology behind it, was very, very powerful. And I had a background in distributed data, and it just was very thoughtful. And I thought that would be a really good place to build. And it seemed like kind of undervalued in 2021. There was a lot of centralized, like quote unquote, Bitcoin only companies that were fully centralized. And I would argue not the best from a trust standpoint. And then started looking at it. And then, of course, a year later, a lot of those blew up. So found ourselves kind of building something that's needed. But yeah, I kind of got into Bitcoin as an accident. Once my friend launched, when they launched the Chivo wallet, my friend was telling me it was getting like 250,000 daily active users. And I'm like, oh my gosh, this is like across the chasm. Everyone's going to have Bitcoin one day. And so that was the information that compelled me to like build on Bitcoin.
And that was, I think, your Bitcoin journey, you said, started in 2011. Bitcoin El Salvador happened somewhere in the pandemic, I'm guessing. And
Fall of 2021.
Fall of 2021. It's been 3 years since then. And in the past 3 years, we've got a lot of action within the Bitcoin space. I mean, it started with ordinals, it started with token standards. Then this year we had runes, a bunch of other things that people thought wouldn't be possible on Bitcoin, and it is now. So how did you end up taking that sort of whatever was happening within the Bitcoin space and said that let me build something like dlcBTC? And in that answer, if you could just sort of tell us what it is a little bit more, because it is an abbreviation, and probably can you expand on that as well?
Yeah, so back in 2021, I am not a cryptographer. I have never been, but I found some academic work that was done at MIT by the creator of the Lightning Network. Actually, those Bitcoin open courseware MIT Bitcoin videos I used to watch, the guy who taught that, Tad Strija, he actually wrote a white paper. He created DLCs, or he invented the idea. He wrote a white paper 6 years ago, basically saying, like, how could we have smart contracts on Bitcoin? Well, maybe if you use this DLC mechanism. And I'll go into that, but basically we took that idea and we adapted it to what we're doing now. And then about a year ago, so actually early on, we got a grant from Chainlink to investigate like Bitcoin oracles. Then we got a grant from Stacks. Early on, it was really just Stacks and RSK and some other ecosystems trying to build on Bitcoin. Now you have over 100 Bitcoin L2s, so it's really been an explosion. But back 3 years ago, it was kind of almost also a little like politically sensitive in terms of the maxis and like whatever, and people are very adamant not to build on Bitcoin. And anyway, but DLC seemed like something that made sense because basically what a DLC is, and the paper kind of argues this is, let's say you have like Alice and Bob and they want to make a bet on Bitcoin. How do they do it? Well, let's say there's kind of two features of the system. One is that Alice and Bob both put up some Bitcoin and they pre-commit to the amount, to all the outcomes. So it's like kind of like an if-then statement. Like, let's say they bet on a sports match. There's one outcome where Alice wins, another outcome where Bob wins, maybe a third outcome where it's a tie, and they both, it's split back equally or something else. So you kind of set up that if-then statement, and then you need a condition for that. It's an off-chain entity called Oracle, called Olivia the Oracle in the paper. And so the Oracle actually does not know who Alice and Bob are, but the Oracle is a data source where they're just kind of publishing like numbers into a public space. And then Alice and Bob can grab that and build it in. And basically the winning party can redeem, or either party can redeem, but the winning party has an incentive to redeem the Bitcoin that they won. And so that was like a general structure, literally describing an if-then statement on Bitcoin, an if-then else. And so at the time, 2021, there was a company called Shortbits. They really pioneered a lot of the early thinking. They actually built like oracles and betting systems and stuff like that. I came into this space without the benefit of any knowledge. It's just kind of pure, like as a complete novice, started looking at it and said, well, I don't know about like betting and stuff. I don't really use Bitcoin sports betting, but I do use Aave to take loans. And I have some Bitcoin miners, which I still have, and I get Bitcoin, and then I might want to take a loan on it. But then how do I get the Bitcoin into Aave? well, I use wrapped Bitcoin. Okay, but then is there a better system than WBTC? And then that's what got us started on the path to what today is dlcBTC.
It seems like the if-then statement that you describe is very similar, although in a very novice sense to what a smart contract would be on maybe the Ethereum or the L1 space. And this was quite early on. This was quite early on before, say, DeFi exploded, where smart contracts actually were put into use. Before that, it was probably for like your minimal crypto kitties or Top Shot or something else. How did you see this as a problem in the Bitcoin space that was solved in the Bitcoin space, which was probably also solved in the Ethereum space, but not to the same sort of use case that you would see right now?
Yeah, so from an engineering standpoint, the if-then statement and like a Turing-complete smart contract system are like vastly different things. It's kind of like I don't know, if I put three boxes together or if I build a skyscraper, the engineering complexity and effort is quite different. And so that was to us a clue because, and maybe we're kind of a unique building on Bitcoin because we're like, maybe the smart contracts, like maybe the if then could be used for something to enable DeFi, but I wanted to use Aave. I didn't want to use other things than Aave because Aave is awesome. They have never, blown up. ETH is great. Like all these things already, Chainlink is great. Chainlink goes into Aave, great. Like we did not want to rebuild any of that. And so we basically, long story short, we came up with the concept of self-wrapping. So you use the DLC mechanism to just lock the Bitcoin on Bitcoin. You put it into a lock state. And then when you lock it, that mints in the RC20, dlcBTC, that you can use in DeFi and all the regular things. And then you can take advantage of the composability. So unlike the other like building on Bitcoin companies, we are not enabling any kind of advanced features. We're not assuming that there will be smart contracts on Bitcoin. We're not assuming that there will be like fraud proofs and stuff. I hope there will be, and I'm sure there will be more stuff. I don't know what is going to be like approved by majority miners, yada yada, but like or adopted by. But basically, like whatever new tech comes in, we can look to evolve it and have new products. But for today, where we are today, oh, and I forget to mention, November 2021, Bitcoin upgraded to Taproot, and so DLCs were more like theoretically possible with some hacks, but with Taproot, which introduced Schnorr signatures, they became a lot more, I guess a lot more viable. And something else called PTLCs, point time lock contracts. So anyway, basically like that was the time, like it was just kind of dumb luck when we were looking at DLCs became viable on Bitcoin. We're like, cool. So like, what do we do with it? And then over like a period of iterations, we actually used to make DLC infrastructure, letting kind of developers build DLCs. And then we realized, wait a moment, there's very few developers who even like are in this space. It's so new. We're like, what if we build an application? And then we're like, well, what if the application is literally just the locking it to make a token? And then it kind of, it went from there.
All right, there's a lot of things that you've mentioned which points to the infrastructure of DLC, and that's the way you say it, not DLC BTC. So I'm going to say it that way. Okay, you said self-wrapping, right? Self-wrapping is a way where I want you to explain what self-wrapping is within the infrastructure and say that why is it so unique that an entity within the DLC space can self-wrap, and how does a traditional wrapped version of a Bitcoin, let's use the biggest one as wrapped Bitcoin, how does the issuer, in that case BitGo, have a system of wrapping and say minting, which would be the wrapped point, and say burning the Bitcoin, right? Or burning the coin itself. Can you just explain that infrastructure of what it is in the traditional sense, or at least the wrapped Bitcoin sense, and how you guys do it slightly differently?
Definitely. So in the WBTC dynamic, WBT, like you and I, we cannot mint WBTC. We can only swap or buy it. And the reason for that is
When you say you and I, you mean like retail users?
like retail or, yeah, pretty much. So I'll put it this way: only 25 institutions have been whitelisted to be able to mint dlcBTC, and that's called their merchant system. And so basically, you have these institutions like Galaxy, Falcon X, etc., and they get whitelisted, and they also get a BitGo custody account, and they gain the ability to send Bitcoin to BitGo, put it in their BitGo puts in the vault, gives them the ERC20 WBTC, and then Galaxy can resell it basically and make money from distributing it, and that's the merchant model. In this system, BitGo is a central point of failure or central point of risk, because if something happens to the Bitcoin in the vault, then of course WBTC is not backed. Or if BitGo, as in this case, brings in another partner and the viability of that other partner, obviously there's some risk with this Justin Sun announcement. What if he grabs the Bitcoin somehow that's in the vault? All of that would cause the WBTC to depeg or not be backed fully. And so that central point of failure didn't make sense to us, because why would you take the most decentralized asset of Bitcoin, put it into one place, and then use it in ETH and Aave, which is also highly decentralized? That never made sense. So in our system, we have kind of an adaptation of this. It's not perfect because in our system, retail cannot mint. Also, only the merchants can mint, but the merchants mint out of self-custody. So same merchants, Galaxy, Amber Group, etc. We're onboarding the same financial institutions. We're actually expanding the pool of merchants in some interesting ways because we're using technology and we're kind of evolving it. But basically, you have a permission set of backers, and they are the ones who can mint. But they, instead of sending it to us or to anyone else, they lock it with themselves using this mechanism, using kind of the DLC. Basically, picture be Alice locks with Alice. There is no other condition. There's no Bob in this picture, just Alice locks with Alice. And then the oracle is the blockchain you're wrapping to. So let's say Ethereum. So like Alice locks with Alice, the UTXO is funded. That means the dlcBTC on ETH. When it's burned on ETH, the entire ETH validator set validates it, publishes it as an on-chain signal, and that signal is relayed back to the DLC, which unlocks it and sends it back to Alice. So it's a very clean system because we don't add any blockchains, we don't add any, we do add a relay network, which I can talk about, called the testers, which we'll get into, but basically it's like minted from self-custody by these merchants. And so then I guess I should explain, why do we need the merchants? Well, first we started thinking like, what if you and I could mint? That would be cool. I could like lock it with myself in my wallet or whatever. But then what if I'm not a good, what if I lose my private key? Or what if I like mint some dlcBTC, I trade it away and I run out of money and I can't get more? Turns out I am backing all the dlcBTC. Like if 1,000 people have minted dlcBTC, then if you're holding it, if any of those 1,000 people kind of fail on any level, the token depegs. And that just seemed to have like anonymous people minting just seemed too risky versus having financial institutions who have like risk managers and they have backups of their private keys and they just have different assurances. That said, we're not only working, unlike BitGo, we're not only working with the top 25 biggest companies in the world, we're working with a whole bunch of merchants, including some interesting designs on how to evolve that whole system. So it's a lot more robust, but it's not, it is a permission set. It's not a permissionless set of minters.
All right. Thanks for explaining the model within BitGo and within dlcBTC. So you mentioned that the merchants, in a way, self-approve the transaction, so they don't go through a central entity. Like in the case of Wrap Bitcoin, goes through BitGo itself. I wanted to ask, what does DLC in this case do? Is DLC also part of the merchant sort of pool? Or are you just creating sort of the infrastructure where each of those 28 plus merchants will actually self-wrap and issue these coins, issue the dlcBTC?
Yeah, today we are a merchant and we also run one of the relay nodes, but the goal is we will not be a merchant, too far in the future. We are a software company, and maybe this is a really good part of the business here, the business model. is we are not a custodian of anyone's Bitcoin. We're not a financially regulated, entity. We're not subject to SEC or CFTC. We never get anyone's Bitcoin. We are a software company that these merchants can sign an agreement with, where they agree to pay fees for using the software in Bitcoin. So we charge mint and burn fees in the Bitcoin. So they agree to pay the fees for using the software. The software allows them to wrap with themselves. So whatever jurisdiction and whatever regulatory they're subject to, they need to obviously comply with all their local laws. But we don't receive Bitcoin, and so as a custodian, we're not a custodian. So that makes it a lot simpler. So yeah, we're just a software company that makes this product that merchants can choose to subscribe to.
And your sort of revenue model in this case is anything that is minted and burned on either side. There's a fee that is paid in the form of Bitcoin or the minimal Bitcoin that the merchants will mint or burn, and you receive that
Yes.
as revenue, and you use that to, of course, build more software, onboard more merchants. And this is on the supply side, right? Like on the demand side, I mean, this is probably a broader question, like who is using Wrap Bitcoin? We've seen a ton of DeFi protocols use it, a ton of liquidity on LPs, lending pools, etc. But do you have a particular target in this on the demand side? You mentioned retail users will eventually use it through DeFi, and if I'm not wrong, you're live on two L2s on Ethereum right now, on Arbitrum and Base, and soon to come a bunch of others as well. So I just wanted to understand the essence on the demand side as well.
Yeah, definitely. So the number one use case for Bitcoin is borrowing, lend, borrow. Like Aave is the most popular kind of location for where people use Wrap Bitcoin, but also Compound, Morpho, etc. So that's one category, and there are different reasons for that. You can do leverage trading basically. So you can either go into Aave and like take a loan directly, or if you're doing some sort of DeFi protocol, you might connect Aave to be the lending provider for what you. So, for example, Nectar, which is a restaking platform, they have a dlcBTC integration coming where you can deposit dlcBTC and they take a ETH loan via Aave, and then they stake the ETH, and then they get the rewards in that way. So that kind of leads me to the second use case, which is Bitcoin staking. So you can, use dlcBTC and use it to secure proof of stake chains. We're partnering with Symbiotic, Karok, Eigen, just kind of all the usual suspects, Nectar, whom I mentioned. So there's a lot there. A third use case are collateral for stable coins. So for example, you can borrow Curve USD against dlcBTC. I guess that's still lend borrow use case. And then another one are options. So if you can hedge, you can do covered calls to earn a yield while you're holding. It's just regular kind of on-chain options. But those are some of the main categories for Bitcoin in DeFi in general.
And probably two of them on the collateral side, borrow lending, and the option side is something that has been tried and tested in the Ethereum side as well, with ETH and other hard assets or ultrasound assets, like they say. But restaking is something that is new. And of course, Bitcoin natively cannot be staked, but you can use it as security on other chains, which is what a lot of the restaking emphasis is as well. I wanted to understand, how will that work? Will that be a simple sort of if the Bitcoin is locked here as collateral and it's not slashed, then the protocol or the AVS that is using it is a safe one for me to earn yield on, restaked yield on. Is that similar to how it is on the Ethereum side? Or will it be used differently, maybe not as a collateral, maybe some other form of security asset? Just wanted to understand how that will work with dlcBTC specifically.
Yeah, so that is exactly the case. So, historically, you could only stake ETH or use ETH to secure these chains. Then you have this whole generation, or like, second generation, where you have Symbiotic, for example, where you can use any ERC20. And so dlcBTC is a ERC20 that will be able to be used for that. And if it's slashed, then dlcBTC goes to the other party. So and then they can redeem it through the merchant system, just like anyone could. So it's quite simple. And because of this, and I should kind of point out, part of our strategy is to not reinvent the wheel. We believe in DeFi composability. I think that's the best part of DeFi. I think there's a lot of crazy parts of DeFi, and we all know it. But the best part is that these Legos kind of fit together. And so we made the assumption, we are not the smartest DeFi people in the world. We know a little bit about things, but we don't know a lot about it. Someone else is going to build a better vault, a better Oracle, a better lend borrow program, a better restaking provider. Like all these things are going to be, built by teams who are highly motivated and specialized. So if we just get the locking of the Bitcoin, we are like a transport layer. We get the Bitcoin safely over to the ETH side and to other chains in the future, but right now just ETH. Then that can be used there. And whatever people invent on ETH from here on out, if the dlcBTC will be, composable and used in there. And because of that DeFi Lego approach, we actually launched Bitcoin staking like 2 months before Babylon. No, I'm a big fan of Babylon in terms of with the team and the passion and everything, but still they had to like reinvent the whole thing. They had to create everything new. We use the self-custody aspect of Babylon to lock the Bitcoin, and then it goes into the other existing protocols on ETH. And so we were able to demonstrate that, I think like in May or something like that, as when we launched on Arbitrum, because we're not building a new chain, we're not building any of the other stuff. And that made our job a lot easier and I think more scalable.
It's super interesting that you said transport layer and the way you explained sort of software model before this, and now the transport model within the demand side of this, it makes a lot of sense, where you're just putting the Legos together on the Bitcoin security side and on the need for liquidity side, maybe on the DeFi side, and a bunch of others as well, restaking being one of them. Yeah, at least I have a fair understanding. All right, Aki, I wanted to understand a tester and the private key model, just from a security standpoint. It seems like while I was reading through Blockworks article, couldn't really wrap my head around that. And you mentioned that you have 7 attesters. I could be wrong here in the number.
Yeah, no, that's right.
And I think 5 need to be in unison in order for something to go through. So could you just explain the dynamics of that and how that relates to another custodian-like model and not a software type of model that you guys are following?
Yeah, definitely. So this kind of goes back to the DLC model. You have an Oracle in the DLC system design. You have an Oracle announcement when the DLC is created, and you have an Oracle attestation when the outcome is known. And it's basically the signal. So Alice and Bob and Olivia, the Oracle, have kind of created these pre-commitments, and they've traded the signature, whatever and like that kind of unlocks it. So basically, when we were thinking through, because early on we got a grant from Chainlink. And so, Chainlink is a leader in oracles, but there are like many different types of oracles. There's like financial and non-financial data. There's oracles for who won the sports game, what temperature it is, whatever. And so long story short, we realized that what the Olivia the Oracle is doing is actually they're publishing an attestation of an observed state. So let's say so I'll just give you the dlcBTC example because it's very concrete. So let's say, we have these node operators like Hashkey Cloud, P2P, Everstake. They're just like typical large node operators, and they run a Bitcoin node and they run an ETH node. And so when the DLC is created, it's a UTXO on Bitcoin. When, let's say Amber Group as a merchant funds that UTXO, 6 Bitcoin block confirmations later, that's mined by the Bitcoin network and published on on Bitcoin chain, anyone can see that UTXO is funded. But there needs to be an attestation of that. And basically P2P, as one of the attesters in our network, is basically just publishing. They're just saying an attestation that they saw that UTXO is funded. How do they do this? They set up a small server where we have the DLC attester kind of code, and they custody a Bitcoin private key. And they use the Bitcoin private key for message passing. So basically, they use that key to publish the attestation saying, P2P attest that UTXO is funded, essentially. And then they're same on the ETH side. So a threshold of those. We started with a 5 of 7, but then we moved to a 10 of 15. And basically, same thing. On the ETH side, they're running an ETH cluster. When the dlcBTC is burned, that's validated through the ETH network. All this stuff happens there. There's many layers, of course, published as an on-chain signal, and then P2P attests to that they saw that the dlcBTC is burned. And the great thing about this, there's kind of two parts that's great about this. One, we don't need to set up a validator network. Like usually whenever you launch a new chain or Bitcoin L2, you have to spend a lot of years building a robust set of validators. In this case, we're not adding any validators. It's Bitcoin and ETH, and that's it, or an Arbitrum and Bitcoin, and that's it, whatever. So very easy to scale. If we want to launch to a new chain, we just ask the node operators to run, let's say you want to wrap the Solana, fine, run a Solana node. Then you can publish the attestations to Solana and then from Solana. So that's great. Because of the DLC mechanism, Amber has pre-signed themselves as the only one who can ever get the Bitcoin. So there's no way the attesters will ever get Bitcoin. And so because of that, it's I call it a relay network, but it's technically it's a DLC Oracle network. But I try not to use the word Oracle because people, when they think Oracle, they think prices. But it's just an attestation network. And you only need a couple of these guys. I mean, you could, arguably the more the better to some extent, but why might you need more than one? I mean, even one attester can do the job, but if they collude or if they're malicious, they cannot steal, but they can censor the unmint signal. So you've burned it on ETH, but they don't publish the signal, and they do a ransom attack on Amber and demand a bribe. And that's where we want to decentralize the attester network, and we'll launch a token, kind of do all the typical things you would to decentralize a network. But you only need so many node operators, and the node operators actually must be quite large, because the larger they are, the more reputation risk they have, the less likely they are to collude with the other node operators.
Do you have a particular set of node operators in general versus when you're going to a new chain, like you mentioned the Solana example, and you just have to run up a Solana node and that's it? So is there a fixed and a variable amount depending on the chain that you're entering? Currently, you're live on just two L2s, but let's say you go on another L1.
I love where your brain went with that, because theoretically all the node operators should be the same. But in a practical sense, sometimes we're asked to launch to a new chain, and they might not, maybe Hashkey or P2P does not run an injective node or something like that.
Right.
Then we might have to have a different attester network for injective than for Solana or ETH. But to be fair, we haven't run into that situation yet, only because we're only launched on a few chains, and they're all EVM for now, so they're kind of blue chip chains. But as we expand, there might be different attester networks. Or we just convince P2P to run an injective node. That's probably a good thing anyway, assuming that injective as an example, but there are only over 50 blockchains we're tracking to, and not everyone's going to run every node. So yeah, we will find out next year when we're expanding the number of chains we're going on.
What's the roadmap right now? You just have two, and you expect it to launch on a few more?
Yeah, so we partnered with CCIP and Chainlink and Chainlink Proof of Reserve and Chainlink Price Feed Broker. They were in kind of that Chainlink ecosystem. And so the plan that they set out originally, which is a good plan, is Arbitrum base, ETH, Optimism, Polygon. That's kind of on their roadmap. And then from there, so then the Solana, XRPL, et cetera, there's a lot of them. Even emerging L2s like Scroll could come into play, or non-EVM chains like Injective. So it's going to get kind of wacky from there. But basically, for every chain we launch on, it's not a technical lift. We can actually launch a new chain within a few hours. There's really minimal technical lift. It's actually more building the liquidity, building the DeFi ecosystem, plugging in. listing in all the lending platforms on that chain. Just there's a lot of other work involved. Any kind of foundation incentives, that's always helpful. Like marketing so we can launch on no more than one chain per month at the current clip, and maybe it's even slower than that.
Got it. One chain per month that you're already on to, and soon to be more like the ones you've listed out. Um, this is super interesting, at least from a chain expansion point of view. What I wanted to touch upon specifically, given what one of the co-founders of Ethereum just said about yield, is how yield is generated within the Bitcoin space and how it can be and how it's generated in the Ethereum space. Vitalik mentioned that most yield on DeFi within Ethereum eventually comes back to the inflationary asset, which is ETH. And I wanted to understand, so just to paint a picture, do can Bitcoin holders natively earn yield? Probably not. Can they earn it in some other ways using Bitcoin? And what is the yield opportunities for a wrapped Bitcoin holder, any wrapped Bitcoin, dlcBTC being an example that you can take?
Yeah, I think that it would be great if Vitalik wrote a longer post. I think his short tweet was like kind of long enough, but too short to really get into the issue. But I would agree that if your wrap Bitcoin pays a yield, it's not Bitcoin, it's something else. Of course, like by definition. And when we talk to corporate risk managers and professionals, they agree with us. If something is an LST or something pays a yield, it's a security basically, or it's maybe not legally a security today, but it will be a security in the future. So they're avoiding that categorically, right? So and retail can do whatever retail wants to do, but for the professional risk managers, they cannot touch LSTs at the moment for that reason. But there are ways to earn yield. Like the covered call one is great. You take one side of a bet, somebody takes the other side, and depending on what happens in the market, somebody pays somebody. That's a source of earnings, or interest, or fees on things. There are ways to, and of course the kind of the restaking and staking and all of that. There's a financial activity, there's value add there. So those are legitimate, but they're not built into the token because the dlcBTC is just like, it's just a wrap Bitcoin. It doesn't do anything that Bitcoin doesn't do.
But is that what do you think about, say, the yield side on the Ethereum side? But people have argued that Ethereum, of course, is not a security, but you can earn yield on the staking side, and of course on the DeFi side, there are multiple ways to earn yield on it. With Bitcoin coming into the DeFi side, is there any other way that the yield can be anything more than just staking and restaking?
Well, yeah, let's say you've got gold, even taking it out of crypto for a moment, you've got gold, and then a bank gives you like dollars, a dollar loan against the gold, and you take the dollars and you put it into real estate. And the real estate goes up and you earn a yield backed by the gold. That is there are a lot of ways to invest of an asset with value. There's just some of them are built in. I think where it gets just confusing is when the token itself pays yield, then where does the yield come from? That probably comes from VCs or retail, speculation or something else. So as it comes to Bitcoin, as long as the Bitcoin itself doesn't pay yield, but you put it into something, you take a risk. You take, in the case of, Eigen, you take the risk that it's slashed and, that you lose it. So there's a risk reward, and there can be an opportunity for yield that way. So I think that's kind of I responded maybe a little snarkily to that Vitalik post, basically saying he's saying like DeFi is downstream of ETH, and therefore, DeFi can never surpass ETH. I'm like, well, humans make DeFi, and therefore DeFi cannot surpass the value of humans. But like it's sort of like it's yeah, I guess. but like still they could be quite large, and you can use building blocks to make more things obviously you cannot use DeFi to make more humans, but you can use humans to make more DeFi. So
Right.
yeah, okay, like it's just like a weird, it was a weird phrasing, I think.
The merchants that you speak with, who are onboarded to dlcBTC, uh, are they looking to deploy Bitcoin to earn some sort of passive income? Is that a use case for them?
If they have a prop trading desk, yes. So if they have Bitcoin exposure, then they might want to self-wrap, put the dlcBTC into something like a Karak and earn a yield of points. And if they have a team to evaluate that, other ones are delta neutral. There might be market makers looking to earn from arbitrage, or they might have a set of structured products they want to offer to their customers, so on, and then those products can run on dlcBTC. So it's really a mix. I think those are, and also OTC. They might be OTC. So maybe they just want to be able to mint. So when a client wants to buy a chunk of dlcBTC, they are the ones minting it and are charging a spread and then reselling it.
But there's no merchant that you have who is custodying the Bitcoin, like an exchange, for example, and then wants to earn it. That would be a very murky FTX sort of scenario or a Celsius sort of scenario. But
No,
none of
they
that.
they can they can do that. So they can self-custody
Mhm.
and use the dlcBTC as an investment to earn a yield. Those are the prop trading desk or the kind of like the liquidity provision model. So
Right.
let's say you're like a company and you sit on a bunch of Bitcoin, someone will pay you to or you will earn a yield if your Bitcoin sitting there, it's earning nothing. But if you self-wrap it, take a risk by creating this synthetic representation of Bitcoin on ETH, but then you put that into something, take a risk by putting it into whatever Karak, and then you earn in Karak. You've like added some risks to your Bitcoin, but then you also have the reward of doing so.
Do these companies receive the Bitcoin which they self-custody from retail users, or would they be putting their own capital, or is this accredited investor capital? Is there a risk that the person who's supplying it takes?
Yeah, so they can either have their own Bitcoin reserves, which is more common, or they can have clients. Let's say it's a mining network and they
Right.
have some Bitcoin of their own, but they can also have the clients participate. And there's different models of that. So just think of the merchants as distributors or resellers, and then they can take a fee for that. Uh, and it can kind of extend in both ways. I would say they can have themselves or others contribute Bitcoin, and they can use the Bitcoin themselves or resell it or do other things.
And they, of course, would earn some amount of interest or cut on top of that. And the person who's supplying
Yeah,
that Bitcoin, they earn some sort of yield on that as well. So all around
yeah.
efficient movement of capital on the DeFi side versus on the Bitcoin side. And everybody earns a certain amount of interest, which is what a financial model should be.
That's what it should be. A bunch of intermediaries, all value added, different, taking different risks and getting paid for it. And exactly. And just knowing, I think the big part of maybe behind, obviously, I can't read into Vitalik too much, but the big part is like, what is the risk? As long as everybody is very upfront about what the risks are,
Right.
because when people like hand wavy say, my token earns a yield, put your Bitcoin in here, and now you have Aki Bitcoin that pays you 18%. That's then I have not told you about the risks of Aki Bitcoin. And if anyone wants to send Bitcoin to me, my Bitcoin address is printed on the bottom. Just kidding. I promise I will give you Aki coin if you send me Bitcoin. No, please. Uh, I regret saying that. I'm just kidding. But basically, yeah, that's sort of what's going on, right? It's like send your Bitcoin here, and we promise we'll give you something. And it's like, let's talk about the risks, especially when it comes to Bitcoin. Bitcoiners, that stuff really riles Bitcoiners up when somebody just dangles reward and like you don't see the other side. That's not great marketing
Yeah, I
for
think the
crypto.
Bitcoin side is fairly certain about that, that there is a tremendous amount of risk. The Ethereum side, they want to talk about the utility of that risk and more and less about that risk. But this is not financial advice. Anything in this podcast
Yes,
isn't anything from you or from me. Um,
correct.
but that is super interesting, at least the model of at least how the merchants earn the yield, or I don't know if you can call it yield, but let's call it returns. Um, but now that dlcBTC is live, are you looking to build out, and again, I'm going to preface this by saying you are a more of a transport mechanism through software rather than a custodian in any way. Um, but since you are live and tradable, are you looking to build out few more useful products within dlcBTC, something on the programmable side, something on the custodian side, maybe a bridge, yield generator? Is there any sort of larger thought process within this?
I think we can add value-added components on top of the dlcBTC. I don't think we should go in the direction of custodian necessarily because the whole system is on this self-custody, that has this self-custody value prop. I think that's a really unique, value prop. But then we can build things on top of the dlcBTC. And there it's sort of like buy, build, or partner, right? I mean, obviously we're small, so maybe we're not buying anyone, but build or partner. Should we build it in-house, or like let's say it's a stable coin? Should we build it ourselves, or should we partner with someone who's really great at building stable coins? And I think there's a lot of, our goal is to be composable, not to reinvent the wheel. So I think a partnership structure is much more preferable in most cases than us like trying to sit down and create a new thing when other people have done it in more sophisticated ways. So I think we're going to do a lot of partnering and potentially could, I think people in crypto maybe they're so used to retail being able to do things directly,
Right, right,
but then it gets like the UX UI can get complicated. And businesses, yeah, I have a B2B background. Businesses want to buy solutions. They don't want to buy like building blocks. They have a problem, they want a solution. So I think we can build solutions for businesses, whether we build all the components or we partner or it's a mix of both. But net, the customers want to have solutions that achieve ROI goals. And I think we can play a role in that. So it's kind of a murky response, but I will tell you more next year when we're, when dlcBTC has the TVL behind it, when it's large and booming, it's a great ecosystem. We will continue to add value on top of it.
super. You already are adding a tremendous amount of value within a very difficult space on the Bitcoin to programmable side, if that's a way to call it. But I certainly learned a lot about dlcBTC, and I'm sure our listeners, wherever they are, have as well. This has been a fantastic interview, or at least conversation. Is there anything else you'd like to add before we close off?
No, thank you for the opportunity, help getting the word out. I think there's a big conversation to be had about the security of bridges. Yeah, I'd love to have the conversation with anyone at any time because I think there's a lot of the point of Bitcoin is safety, but when it's bridged somewhere, we really have to look at the bridge mechanism. And I think there's a lot of protocols who have not taken the time to explain the risks of their bridge assumptions and mechanism. So anyway, that's what I'm kind of on a rant about these days. It's like if we're getting bit, because if one of these Bitcoin L2s fails or blows up or something, then the whole
Right.
space can get a bad rep. And I'm sure that will happen one day, as it has happened to those building on the Bitcoin only companies that all categorically failed, like Celsius, BlockFi. We're going to have that moment with unsafe bridging in the future, and we should just be aware, kind of caveat emptor, buyer beware. So I think there's more to be discussed there as a community.
You guys are certainly doing a good job of bridging or wrapping, if those words are interchangeable. And if anyone wants to have a conversation with you or engage with your rants, as you said, they can reach out to you on Twitter. I have it here, and you can correct me if
Yes,
I'm wrong. AKIBALOGH, Aki
yes,
Balogh on Twitter. dlcBTC is,
ye-
of course, dlcBTC, and the website is
yes.
dlcBTC.com. Is there any other way folks can get in touch with you?
We have a Discord. The link is kind of buried on the bottom of our website, but if you find the link, please join. Feel free to ask in the Discord community as well.
Awesome. Thanks, Aki, for this conversation, and I will see you on the rant side of Twitter.
Thanks for the opportunity. Talk again soon, I'm sure.